This is the current federal tax developments for the week of September the 28th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and the State Societies of CPAs. I'm Ed Zollers, and I'll be working with you this week looking at some issues that have occurred here in the tax area. So we're going to be looking at two sets of final regulations that came out, one of them on bonus depreciation, the other one dealing with the excess deductions on termination. Both of these were triggered by the Tax Cuts and Jobs Act. And then we're also going to talk about the relief the IRS gave for the CCH e-filing crash that took place on the due date for partnership returns that some of you were dealing with. We'll talk about what they told us about that, as well as what appears to be kind of a disguised warning in the future, I guess. Best way you could talk about it. Let's go ahead and let's talk about the bonus depreciation regulations first, though. This is Treasury Decision 99116 issued on September the 21st of 2020. And what they did, they put out an additional set of regulations. We had already had one set of final regulations, I should say, on the bonus depreciation rules. And Congress, or I should say the IRS now came back and they cleared up a few other issues for us in that regard. They were issued in proposed form back in 2019 for most of it. However, because of the CARES Act, we got a new qualified improvement property set of rules that are in place for this year. And we'll be talking about how that goes and how they're going to try to work around that issue. They also made some other revisions from the other revisions from the proposed regulations, I should say. So the final regulations have some minor changes. So let's start talking about some of the sections, and we're not going to talk about everything in here. We're going to talk about some of the ones I think are of most interest to people that are, tuning into this broadcast. So we're going to talk first about the IRS's rules that dealt with floor plan financing interest and that impact on bonus depreciation. As you may remember, there's a special rule that allows you, if you have floor plan financing interest, you can treat that and add that and claim a deduction for that, even if you're otherwise limited by the business interest limitations of 163J. But the trade-off there was that you have to end up giving up your right to claim bonus depreciation for the year in which you're using the floor plan interest. Every year you have floor plan interest, the law was stating, you pretty much had to give up getting bonus depreciation. Now, the IRS said, okay, we kind of understand that some of you maybe don't need that and you don't have the problem with the interest. So the IRS put into the proposed regulations a rule that allows you to, claim the bonus depreciation in a year where the floor plan interest rule did not give you an additional deduction based on the business interest deduction rule. So that retains in the final regulation, that's still there. However, some people were trying to argue that, well, on all the other things like for real estate and for farming, you elect to have these rules apply. And if you don't elect, then you give up some of this, you got bonus depreciation and you elect to get your interest. And they were saying, well, really, shouldn't we be able to elect to ignore the special treatment of floor plan interest and claim our bonus depreciation because perhaps, we're going to be using it, but it could be a very minor amount because under the IRS rule, if you have $1 of floor plan interest that pushes you above what you're allowed to get if that had not been floor plan interest, you're going to be losing all your bonus depreciation. The IRS said, unfortunately, that's not how the law reads. The law itself, for reasons that only, I guess, those who were, pushing this or trying to get this into the law could tell us, the law itself does not allow any special provision here. There's no election. The IRS said, look, if there's no election, we can't actually create one out of thin air. So like it or not, we're not going to be able to allow you to opt out of this and somehow convert this over into a setting where you'd be able to take your bonus because, yeah, it might be greater than you'd get with the floor plan interest, but the trade-off in the law was, those who have floor plan interest, car dealers and similar groups, you've given up the ability to use bonus to get your floor plan, and that's how this was written. We also had a change here with some rules on what's called the 5-year look-back rule for a prior depreciable interest. And this all revolves around the problem of used property. If you remember, prior to the Tax Cuts and Jobs Act and the 100% bonus rule enacted there, you didn't get to take bonus depreciation whenever you had used property. Well, the TCJA allows you to take depreciation if you have used property, but they were concerned that there was going to be a problem if you could essentially get rid of property and then get it right back and depreciate it again a second time, bonus depreciation. So there is a prior depreciable interest rule. Used property is not a problem as long as you didn't previously have a depreciable interest in it. Well, the IRS decided that really that shouldn't be an infinite time period. So in the proposed regulations, they created a 5-year look-back rule. That is, you would look back 5 years and determine if you had depreciable interest in the prior 5 years. And if you didn't have a depreciable interest in the prior 5 years, then you could go ahead and pick up the property, acquire the property, and write it off, even if you had previously owned it, let's say 7, 8, 9 years ago. Well, in the regs, they did clarify here that the look-back period is the prior 5 years. So, if you're looking at 2020, you'd be looking at 19, 18, 17, 16, 15. Plus, in 2020, you would look for the period from the beginning of 2020 till the time you acquire the property that you're going to try to claim the bonus depreciation on. And if you had depreciable interest at any of those times previously, then you'd be barred. So, we've got that particular. We want to clarify that to make clear how you count the 5 years. So it would be actually, the 5 immediately before you and the part of the year before would count. They also clarified that if you were successor entities, that the taxpayer and the predecessors are subject to separate testing periods. So we have that in that regard because you don't count any period you weren't in existence. So but your predecessor will count the periods they were in existence, and we'll do testing that way for both because, yes, finally, it only covers the period you're actually in existence. So as I say, a little bit of clarification there on the 5-year rule that's going to help us some in dealing with this when you have to deal with it with your issues. The IRS also did another thing to help us simplify matters. They have a de minimis rule here. And the de minimis rule was meant to be if you had a very, very minor usage of the property, we were not going to count that against you. They made a few clarifications to that here. The de minimis rule pretty much is where you acquire the property, you only hold it for a very short time period. Even if you're still within the 5-year period, if you acquire the property and you didn't hold on to it for more than 90 days before disposing of it, that's not going to count against you if you later reacquire the property. Now, they first started with some questions. A commenter had some questions for 3 cases. The first case they asked, well, what happens if I acquire the property in January, I dispose of it in less than 90 days, then I reacquire it the same year? Basically, shouldn't I be able to claim the bonus on that second transfer, the reacquisition? And the IRS agreed that that was okay with one caveat. It cannot be property that you had acquired prior to, prior to September 28th of 2017. That obviously be if you're emitting a 2017 return. That was the year that we put this in, and prior to September 27th, the asset would not have qualified for bonus. So if you did some structure to try to get rid of it and get it back right after, they're saying, yeah, we're not going to let that go. But otherwise, that whole acquire, dispose, reacquire the same year, that's fine. What if you acquired in 1 year, let's say 2019, less than 90 days later you disposed of it, but you'd acquired it in like mid-December, so you're disposing of it in early February. And then you reacquire it again in the following year. In that scenario, they're going to give you bonus depreciation on the first time because, again, as always, we're kind of stuck with the rule that we have to look at what happens at each year. And the issue becomes whatever's going on in that year is kind of what we need to look at. So whatever is happening that year, we don't know at December we're going to get rid of it. So since we didn't know we'd get rid of it at the end of December, we're going to go ahead and, take it, with the first year depreciation, right, is allowable for that year 1 in this, right, when it's placed in service, and in year 2 when it's placed in service again, because what's going to happen in that case is you're going to obviously have a disposition cost in the interim. So they're saying, yeah, that's consistent. De minimis use still won't cause us a problem with that scenario because you only used it for a few days, so you're stuck with a full recapture. You're stuck with mainly full recapture. So yeah, we're going to be okay with that. Finally, they looked at the issues if you had a multiple distribution. Okay, how about this? We got the property in January of this year. We then got rid of it before the end of February. Then we got it again in September, but we got rid of it by the end of October. And then a couple years later, we reacquire. Well, the IRS said that's one too many. We're not going to let you have the scenario, you only have one 90-day period. So the first acquisition starts a 90-day period running. Any disposition outside that 90-day period, including from a later reacquisition, is going to be considered to be blowing the de minimis test. So if you have it more than once, we're not going to let you run two separate 90-day periods. You're only going to be able to run one, and it starts with the first acquisition. You're not going to get a second acquisition and a second attempt to run it through. Now, moving on to the next part, the IRS decided to get rid of entirely a provision that had been in the regulations, proposed regulations, for a look-through rule on partnership interest. So if you were a partner in a partnership, you would be deemed to have a depreciable interest in any asset that partnership had held during the prior 5 years, and that could cause you to be unable to reacquire it in other entities. Now, some of the people who are looking at this claimed, well, look, it's awfully burdensome because if I have like a very small interest in a partnership, I may not even be aware that partnership had the ownership interest in this asset that I acquire for my business. So, and I'm going to have to go check. Theoretically, every time I acquire an asset that's not new, brand new usage, I've got to go check and make sure that partnership never had an interest in it, even though I had this super minor interest. I may have trouble getting anybody to pay attention to me to figure out if I had that interest. So the IRS said, yes, we agree that's overly burdensome. And we're just going to withdraw the rule entirely from the regulations. The commenter had suggested some change to it, but the IRS decided that change really would just make it duplicative of other tests. So bottom line, we're not really going to worry about that. We're going to go ahead and just get rid of this thing out of the regulation entirely. We've decided it was not necessary, and therefore we don't need it. So the idea being we're just going to let it go forward as is. Don't worry about that. That's gone from the reg. We also had some modifications to a set of rules on a series of related transactions. This is where you have a structure, where you have an asset that goes, to multiple entities. And the concern here is somehow using that to move the used property around. So under this issue, some people were concerned about how it would go. So they've clarified it up now. They make it clear that you test for related entities and related transactions immediately before the first transfer in a series. So all entities in the series are tested. They have to look back and do a test as of their status on the day the whole series started. Then a second test at the time they acquire the property in the series of related transactions. They did provide provision revised in the final regulation to ignore certain transitory relationships. You have for a short period of time, a corporation is formed and dissolved, or we acquire a corporation immediately to dissolve it. We're going to ignore any relationships that might have existed with that corporation we acquired as long as we dissolve it immediately. We're then just acquiring the asset from that corporation. So we're looking at our, interactions with anything of that sort, but we're not worried about that corporation's relationships. We just acquired it from a previously unrelated party. We didn't have a problem there. We're not going to create a whole bunch of relationships with that very transitory corporation being there. And if you acquire something during the transaction from an entity that was not in existence at the start, then we're going to apply the test by looking at the predecessor. So again, one of those things, kind of an anti-abuse rule, but they did put some simplifications in. Now, here we have a complication that Congress put in on them. While these regulations were out there in proposed form, Congress added the CARES Act, went back and fixed the problem we had with qualified improvement property, right? Qualified improvement property was supposed to have been eligible for bonus depreciation in the Tax Cuts and Jobs Act when it was first passed, but unfortunately, Congress fouled up the drafting. Now, obviously, when the IRS did these regulations, the law provided that it didn't qualify for bonus. Now it suddenly does. So they did add a definition in there to allow bonus property to allow qualified improvement property to be eligible for bonus depreciation. But in the preamble, rather than the regs, they gave a discussion of a provision. In essence, the property in question has to be property that was placed in service and made by the taxpayer. So what does made by the taxpayer mean? And the IRS tried to explain this issue. What they're saying is, look, if you go out there and you rent a building, right, or you buy a building, and you have the property put in service, and then you go and you hire a contractor to put in improvements, that's still an improvement made by the taxpayer. What doesn't work is if you acquire the pre-existing building, it already has improvements in it. That's what the law was getting at. You couldn't go back in and kind of do the equivalent of a cost seg study, but this time just looking at qualified improvement property. Qualified improvement property, you have to have the building first, and then you have to be the party to improve the property, not the party that had it before you were using it. So bottom line, they clarified what that meant. And they also clarified that if you have property acquired non-recognition transaction, by that they mean like a incorporation under 351, or you form a partnership and 721's in play, that property that was qualified improvement property to the predecessor, let's say the individual for incorporating a C Corp, let's say, the old partner, if we're bringing them into the partnership, that'll still be qualified improvement property for our purposes, except for any amounts that we later add to. So if we paid for an additional, let's say we had an additional amount that we paid in, we had some boot or whatever we're throwing in, there's some additional cash paid in, anything that we did doesn't come by reference to their basis, we're going to go ahead and we're going to pick that up as not, not qualified improvement property because it didn't begin with us. That's going to be the key for that standpoint, but otherwise it'll retain its status. They also clarified the breadth of a transfer predecessor rule that was in the proposed regulations. Some people were concerned that a single transfer from one party to another would bring those rules in and get them quasi-related for anything from here forward. And they made it very clear it only applied to a single transfer, that having this kind of relationship once did not make you forever tied in. So they reworded the minor editing changes to the regulations to clearly reflect this treatment, that it's not going to stay around forever. So that was a pretty simple clarification. Nothing really major there. There's some other provisions here we're not talking about. It does have some revisions that will be of interest if you do a lot of work with consolidated groups. And also certain corporate acquisition liquidation transactions are discussed here. We're not covering those in detail here because they're probably beyond the scope of what a lot of people here are interested in for this particular broadcast. We don't have a lot of C Corps and closely held entities at this point. We have a lot of closely held people that watch this tend to do a lot of closely held corporations. So we're not going to worry about those issues, but I will want to let you know, if you are interested in that is in the regs. So be aware of that. Okay, let's go on now and talk about something that is of interest if you deal with trust or estates for income tax purposes. This is Treasury Decision 9918 that was released again on September the 21st. The Tax Cuts and Jobs Act again influences this. This is when the Tax Cuts and Jobs Act added the provision in Section 67G that provides that miscellaneous itemized deductions will not be deductible to an individual. Okay, great, except that excess deductions on termination per the IRS regulation at 1.642H-2 were considered to be excess deductions, were considered to be miscellaneous itemized deductions by the individual shareholder, by the individual. So, the problem now, did Congress really intend that beneficiaries of a trust, because 642 is still around, did they really intend that beneficiaries of a trust were going to lose those deductions even though we're going to still compute them? And the IRS decided, well, that maybe didn't make sense. So they went to revisit this issue. So the idea of this was to revisit the excess deductions on termination issue and other related items. I mean, what exactly is the impact of this on a trust and on their beneficiaries? And what the IRS decided was that things had changed. The Tax Cuts and Jobs Act indicated that we needed to look at this stuff differently than we had previously. That the Tax Cuts and Jobs Act said it didn't make sense anymore to treat them as miscellaneous itemized deductions. So the IRS has issued these final regulations to clarify a few issues, major one though being excess deduction on termination. But they did clarify one other issue right up front. Some people have been really worried, and we already had this clarified in a revenue procedure issued back in 2018, but it's now in the regs. Uh, Anything allowed as a deduction because assets are held in trust under Section 67E automatically overrides Section 67G's bar on deductions for miscellaneous itemized deductions. So, for instance, your trustees' fees, the accounting fees for the accounting for the trust, the fees to prepare the 1041 or the estate tax return. Those are all considered to be 67E expenses due to Regulation 1.67-4. That hasn't changed here. So the bottom line is you're still going to get to deduct those on the 1041. This didn't change that. 67G did not make those non-deductible. Now, other thing they're going to say is tell us the thing you're not going to rule on. They specifically declined to discuss how these 67E rules and other rules impact the alternative minimum tax. They said that's beyond the scope of this regulation. Most likely, it's going to mean that, again, they're not miscellaneous itemized deductions. It's tough to see how they're going to still count for AMT purposes to be non-deductible, but, keep your eye on it. Obviously, if you get a distribution of something that's taxes, you're going to have to treat that a little differently. That'll be subject to AMT disallowance still, but that's really not the issue. The major change was the beneficiary's treatment of excess deductions on termination. And what we've been told here is that excess deductions on termination will retain their status. Now that means that we have to do something very, very similar to our computation of what makes up distributable net income when we go to get the amounts to put on the K1s for the beneficiaries. Remember, as we do that on the K1s for the beneficiaries, we're looking at trying to figure out what exactly is the makeup of DNI, because what goes on the K1 is the beneficiary's allocable share of DNI, pretty much regardless to what the trust document says about how we're really computing trust income. DNI and trust accounting income aren't the same thing, so there can be a real divergence of the two. But the regulations tell us in computing what makes up DNI, because by definition it's a net income number, so how do we figure out the ratio there to put in all the nice boxes on the K1? Well, what we do is we go through a three-step process. And the three-step process you have for DNI is you first allocate any deductions against expenses, right, against any income that they're directly associated with. So, we do that. So if you have a rental property, you allocate the rental expenses against the rental property. Okay. After you've got rid of all those that can be directly allocated to a specific item of income, you then take a look around and see, okay, what other expenses do you have? And then you take those expenses and you can then offset those unassociated expenses, which includes the purely unassociated expenses. Plus, if you have deductions in excess of the income they're associated with, those are also freed up. So if you had a business that had a net loss and that you materially participate in, that would free up those deductions as well. So they can go offset trust income as well. So you can go ahead then and offset that down. And if you do that correctly, you can try to get rid of the bad income, right, and leave the good income, like qualified dividends going through on the K1, rather than having ordinary income from a distribution from an annuity, because you'll try to load up the expenses on the annuity and leave the qualified dividends alone as much as you can. Well, the same thing is going to be true on excess deductions on termination. You're going to try to look at dividing it up. Since they retain their status, anything deductible above the line in computing trust income, right? So 67E is above the line because you're using computing AGI for the trust. That's going to be deductible in computing AGI for the beneficiary. So we're going to want to try to make as much as we can. The only expenses left over are those that are above the line. So if you have some below the line expenses, like you have, let's say, some personal property taxes that are going to be treated as 10 grand capped and miscellaneous deductions, they would still retain that status on the individual return if they survive getting out. So of course you're going to try to use those up against income first. Understanding the same three-tiered rule applies. First, we have to take all directly connected expenses against income. Then and only after that's done can we then go look at allocating our other income against our other expenses against income. And obviously what we hope is at that level we've survived enough to take those we have enough income to survive, take those personal property taxes and absorb them, leaving us with just the above the line deductions for purposes of claiming, excess deductions on termination. Reporting issues are discussed briefly in the preamble. As they tell us, reporting is going to be we have to do the reporting, tell the beneficiaries the makeup of things. They remind us that, essentially beneficiaries, what your beneficiaries do. There are instructions already on the IRS website that have been there before for the proposed regs about how beneficiaries for 18 and 19 should reflect this or how they may want to. They do say we're going to be modifying the instructions for the 2020 1041s and for the 2020 1040s to reflect these regulations. So generally, if you have excess deduction on termination, you're going to have to provide the beneficiaries with a description of what exactly are those above the line expenses, are those, deductions, not miscellaneous itemized deductions. How do we claim? How is that broken down? So you're going to have to put that out to each beneficiary. Now, they did have a couple of clarifying issues too. Some people have suggested, you need to modify the regs because net operating losses now can be carried back after the CARES Act. And the IRS said, no, we don't have to do that. They said, here's the problem. You've never been able to carry back an excess, basically an NOL carryover that remains when the trust or estate ends. They are carryovers. They have to go forward. As the IRS points out, the trust is the one that first gets to try to carry back. Since we have to do the carryback at the trust level, we've already done a carryback. This NOL still survives. Some amount of that does, since there was not enough to carry it back to. When it gets to the beneficiary, it's got to go forward. It can't go back. Because of that, there is no implication here of the CARES Act. The CARES Act does not impact this. And then what I thought was the most interesting point, because they decided to actually deal with it in this, because it occurred to a few people. Well, if we're saying the proper way to treat excess deductions on termination is that we should, we keep the same status as we did before, and some of these are above the line. Well, if that's the right way to do it, can we go back and amend an open return like 2017 that's pre-TCJA, and can we then fix it, get those deductions above the line? They could help us lots of ways. If we had AMT, we'd actually get to use them. If we were, if we weren't itemizing, we'd get to use them. If we lost some of them due to the 2% haircut, we'd get to use them. And the IRS said, no, guys, this is purely post Tax Cuts and Jobs Act. And specifically, that's justified because the prior way of looking at it was justified under the law. In essence, there's more than one reasonable way to interpret how this should be treated. And we're just switching from one reasonable interpretation to another. And because of that, that's not something that's going to allow you to go back and make a change based on this. Very clearly, they state these regulations do not apply, either these or the proposed. You cannot be used on a year prior to 2018. So you're stuck with the old rules for 2017 and earlier. You get the new rules for 2018 and later. Now, something I know a few of you had to deal with. There was a little problem. If you use CCH's tax systems, ProFX or Access, and you didn't have all your partnerships done by, depending upon where you were, late afternoon, early afternoon, I guess if you're in Hawaii, maybe, we're talking about morning, you'd have all of them done and transmitted by then for your 9/15 deadlines, because in many cases, the client hadn't got the authorization back to you. Suddenly you had a problem. The CCH e-file system essentially went down on the afternoon of September 15th, and it didn't come back up until after midnight for essentially everyone, right? So everybody had this problem if you were with CCH. So any returns that you had not transmitted by the time it went down were not able to be filed on September 15th. That's a problem, right? And we know there are some real problems. So for instance, you cannot elect out of the Bipartisan Budget Act partnership audit rules unless you got the election out prior to, in essence, you got the election out on a timely filed return. If you're filing the partnership return after, midnight on September 15th, you're late. And late means that you're going to be owing the late filing penalty, which, depending on how many part years you have, could be a lot of money. And then number two, any elections that had to be made on the original return are now not valid. We've lost every election. So the IRS said, okay, we understand the problem. So they issued this memorandum for all services, enforcement employees, external tax software, tax software, I should say, on September 15th, 2020. Letter issued by the IRS. They are going to provide relief if you were affected by that, and the return was finally transmitted no later than September 17th. So you had till the 17th to get it out. So they gave you the 16th, I guess, 16th and 17th to recover from this. I guess their theory being if there's some reason you couldn't do things on the 16th, maybe power went out your office, I don't know what, they give you one more day. They did not give any extra days. Some people, I believe the Texas Society of CPAs, were asking IRS to make this all the way to the end of September. IRS didn't do that. They said, no, we're not giving you that much time. You need to correct things faster than that. They also put a bit of a warning in the letter, which is kind of interesting. They have interesting language in the letter at the end. And more interesting is what they chose to highlight. What the IRS says in the letter as part of this, as a matter of routine course, the IRS encourages all taxpayers who cannot file on time to file for an extension if they are eligible. Obviously, that wouldn't help in this case. A taxpayer who's not eligible for an extension should make, underlined, every attempt, in the underline, to file on the due date or as soon as possible afterwards. They had that specific emphasis in there, every attempt. Now, I'm not sure what that meant, right? What that warning is meant to do. You can read it a couple of ways. I suspect it may be a justification for not allowing it through like the 30th of September. It's like, if this occurs, you need to stay on top of it. And when you get a chance to file in a very reasonable time after you finally get a chance, you should transmit. You shouldn't sit there and say, dang, the software was out. Well, I got 3 weeks to do this now. Nope, software is out. You need to be ready to go as soon as that software is back up and running. It could also be read that don't expect us to be this nice in the future. Kind of hoping that's not the point, because these things you can't really control. But my guess is, yes, they're putting that warning out. So anybody who whines about the fact that, I was sick, I didn't do it, that's not enough time, we were so upset, we were distraught, we couldn't recover. It's like, no. You need to do it as quickly as possible. And if you had a valid reason, let's say you had a pre-scheduled medical appointment or a pre-scheduled medical procedure, so you were basically unable to file, that's a different cause, and you can ask for relief from the IRS separately, and they'll take a look at that. Well, not going to have a lot of CP coming up to be presenting to you for the next few weeks because you guys are in deadline mode. Did a whole set of courses this week, but I will have some coming up. At the end of October, we begin. I've got a couple of in-firm sessions shortly after the 15th. So the first one I have available to the public will be on October the 26th for New Jersey Society of CPAs. That'll be on construction contractors, special tax and accounting considerations. So if you're in, if you want to go for that one, you can. New Jersey, will be a webcast. All of these right now will be webcast. I do not right now. I have nothing I can say for sure will be a live session, so we're just going to play that by ear. In fact, I know already most of my sessions, the vast majority of my sessions, all the way through the end of December, are already confirmed to be doing webcasts this year. So, yeah, it's going to be webcasts. That's good news, bad news. There are good and bad things about webcasts, so we'll have it. The good news about them is that you can take them anytime you want, and you don't really need to get dressed up for them. The bad news is it's a little bit tougher to handle the networking side in that case. I'm also going to be doing, for the Idaho Society of CPAs, I'll be doing a webcast on the 29th and 30th of October. I'll be doing Preparing Complex 1040s. That'll look at a bunch of the special rules that impact us on 1040s, including some of the CARES Act changes to NOLs. We'll also look at fringe benefits on October 30th, and that's going to contain some issues with the new Secure Act as that impacts retirement plans. So if you're interested, be sure to sign up for one of those. This has been the current federal tax developments for the week of September 28th. Be sure to catch our updates online at currentfederaltaxdevelopments.com. You can send questions and comments to me, Ed Zollers at currentfederaltaxdevelopments.com. Follow me on Twitter at Ed Zollers. I also take a look at the Connect sites and post there for the Arizona, Illinois, Minnesota, New Jersey, and Washington societies. So if you're a member of one of those, make sure you check their online discussion groups. And I kind of keep my eye out for what's going on there. I also look in from time to time when I get a chance at postings on Cal CPA's Tax Talk, so you can take a look there. In any event, this has been the tax update for this week, seeing what's going on. We'll hopefully see what happens in the next week. It's going to get a little more fun for me because just like you, I've got a whole bunch of things to do. And by the time we get to next week, we are into the individual, really rush time. Last 2 weeks for individuals have to be absolutely filed. So got our trusts out of the way and estates, and now we're in the middle of this thing. So be sure to check in, though. We'll see what's happening. I'll try to let you know if anything happens. They're threatening yet again to try to pass another COVID-19 bill. I don't know that's going to go anywhere. My guess is, as I said before, when that finally happens, it will happen so quickly you won't believe it. And it'll probably happen at a time you believe it never could. So we'll see what goes on. But for now, whatever we get, we'll talk at least some next week about what we have when we come back for current federal tax developments.